Interpretation of financial statements. Introduction. Welcome to Interpretation of Financial Statements, turning numbers into meaningful business insights. Financial statement interpretation involves analyzing statements to assess companies' financial health and performance. We'll derive meaningful insights about profitability, liquidity, efficiency, and solvency. This analysis enables informed decision-making by various stakeholders. Key performance indicators. Financial ratios serve as key performance indicators for business analysis. Main categories. Profitability ratios measure ability to generate profit. Liquidity ratios assess ability to meet short-term obligations. Efficiency ratios evaluate asset and resource utilization. Solvency ratios measure long-term financial stability. Each category provides different perspective on financial performance. Profitability ratios. Profitability ratios measure companies' ability to generate profit. 1. Gross profit margin. Formula: gross profit margin equals gross profit divided by revenue times 100. Example: gross profit equals $50,000, revenue equals $200,000. Gross profit margin equals 50,000 divided by 200,000 times 100 equals 25%. 2. Net profit margin. Formula: net profit margin equals net profit divided by revenue times 100. Example: net profit equals $30,000, revenue equals $150,000. Net profit margin equals 30,000 divided by 150,000 times 100 equals 20%. Liquidity ratios. Liquidity ratios assess companies' ability to meet short-term obligations. 1. Current ratio. Formula: current ratio equals current assets divided by current liabilities. Example: current assets equals $100,000, current liabilities equals $50,000. Current ratio equals 100,000 divided by 50,000 is equal to 2.0. 2. Quick ratio. Acid test ratio formula: quick ratio equals current assets inventory divided by current liabilities. Example: current assets equals $100,000, inventory equals $40,000, current liabilities equals $50,000. Quick ratio equals open parenthesis 100,000 minus 40,000 close parenthesis divided by 50,000 is equal to 1.2. Efficiency ratios. Efficiency ratios assess how effectively company utilizes assets and liabilities. 1. Asset turnover ratio. Formula: asset turnover ratio equals revenue divided by average total assets. Example: revenue equals $500,000, average total assets equals $250,000. Asset turnover equals 500,000 divided by 250,000 is equal to 2.0. 2. Receivables collection period. Formula: receivables collection period equals receivables divided by revenue times 365. Example: receivables equals $30,000, revenue equals $150,000. Collection period equals open parenthesis 30,000 divided by 150,000 close parenthesis times 365 is equal to 73 days. Solvency ratios. Solvency ratios measure long-term financial stability. 1. Debt to equity ratio. Formula: debt to equity ratio equals total debt divided by shareholders' equity. Example: total debt equals $200,000, shareholders' equity equals $400,000. Debt to equity ratio equals 200,000 divided by 400,000 is equal to 0.5. 2. Interest coverage ratio. Formula: interest coverage ratio equals EBIT divided by interest expense. Example: EBIT equals $60,000, interest expense equals $20,000. Interest coverage ratio equals 60,000 divided by 20,000 is equal to 3.0. Interpreting profitability ratios. Understanding what profitability ratios reveal about business performance. Gross profit margin measures efficiency in generating profit from sales after direct costs. Higher margin indicates more efficient cost management. Industry comparison provides context for evaluation. Net profit margin shows percentage of revenue remaining after all expenses. Higher margin indicates better overall profitability. Reflects management's ability to control costs and generate profit. Interpreting liquidity ratios. Interpreting liquidity ratios. Understanding liquidity ratios helps assess short-term financial health. Current ratio indicates whether company has enough short-term assets to cover short-term liabilities. Ratio 1 indicates good liquidity position. Ratio may first signal potential cash flow problems. Quick ratio. More stringent liquidity test excluding inventory. Ratio 1 suggests company can pay short-term liabilities without selling inventory. Provides better assessment of immediate liquidity. Interpreting efficiency ratios. Efficiency ratios reveal how well company manages resources. Asset turnover ratio measures how effectively company uses assets to generate sales. Higher ratio indicates more efficient asset utilization. Industry benchmarks help determine optimal levels. Receivables collection period shows average time to collect payment from customers. Shorter period indicates more efficient collections process. Longer periods may indicate collection problems or lenient credit terms. Interpreting solvency ratios. Solvency ratios assess long-term financial stability. Debt to equity ratio shows relative proportion of debt and equity in capital structure. Lower ratio indicates less reliance on debt financing. Higher ratios may indicate higher financial risk. Interest coverage ratio measures company's ability to meet interest payments on debt. Higher ratio indicates better ability to service debt. Low ratios may signal potential financial distress. Trend analysis. Analyzing ratios over time provides valuable insights. Trend analysis benefits. Identifies improvement or deterioration in financial performance. Reveals patterns and cyclical variations. Helps predict future performance trends. Example: comparing current year's profitability ratios with previous years to assess whether company is improving or declining. Key consideration: multiple periods provide more meaningful analysis than single period snapshots. Common size financial statements. Common size analysis expresses items as percentages for easier comparison. Definition: each item expressed as percentage of base figure. Applications. Income statement: each expense item as percentage of total revenue. Balance sheet: each asset or liability as percentage of total assets. Benefits: facilitates comparison across different sized companies. Highlights relative importance of different items. Enables trend analysis over time. Industry comparisons. Comparing ratios with industry benchmarks provides context. Industry analysis benefits. Determines whether company performance is above or below industry average. Identifies competitive strengths and weaknesses. Helps set realistic performance targets. Considerations. Industry ratios may vary significantly. Company business model may differ from industry norms. Economic conditions affect entire industries. Limitations of ratio analysis. Understanding limitations ensures proper interpretation. Key limitations. Historical nature: ratios reflect past performance, not future potential. Industry differences: ratios may vary significantly across industries. Accounting methods: different accounting policies affect ratio comparability. Economic conditions: external factors influence performance beyond management control. Best practice: use ratios as part of comprehensive analysis, not in isolation. Practical case study. Let's apply ratio analysis to practical example. Company financial data. Revenue, $1 million. Gross profit, $400,000. Net profit, $150,000. Current assets, $300,000. Current liabilities, $150,000. Total assets, $800,000. Total debt, $200,000. Equity, $600,000. Calculate key ratios. Gross profit margin equals 400,000 divided by 1 million times 100 equals 40%. Net profit margin equals 150,000 divided by 1 million times 100 equals 15%. Current ratio equals 300,000 divided by 150,000 is equal to 2.0. Debt to equity equals 200,000 divided by 600,000 is equal to 0.33. Stakeholder perspectives. Different stakeholders focus on different aspects of financial analysis. Investors. Profitability ratios for return potential. Solvency ratios for investment security. Efficiency ratios for management effectiveness. Creditors. Liquidity ratios for short-term payment ability. Solvency ratios for long-term repayment capacity. Interest coverage for debt service capability. Management. All ratio categories for comprehensive performance assessment. Trend analysis for strategic planning. Making investment decisions. Financial ratio analysis supports informed investment decisions. Decision framework. Strong profitability plus good liquidity plus efficient operations plus stable solvency equals attractive investment. Weak performance in multiple areas equals higher risk investment. Risk assessment. High debt levels increase financial risk. Poor liquidity may indicate cash flow problems. Declining profitability trends suggest operational challenges. In this video, we've explored comprehensive financial statement interpretation. Financial ratio analysis transforms raw numbers into meaningful business insights. Four main ratio categories provide different perspectives on company performance. Profitability, liquidity, efficiency, and solvency ratios each serve specific analytical purposes. Trend analysis and industry comparisons provide essential context for interpretation. Understanding limitations ensures ratios are used appropriately in decision-making. Different stakeholders focus on different aspects based on their specific interests. Comprehensive analysis combining multiple ratios provides most reliable assessment. Congratulations! You've mastered the fundamental concepts from basic accounting principles through advanced financial statement analysis. These skills form the foundation for professional accounting practice and informed business decision-making. Remember, financial accounting is not just about numbers, it's about telling the story of business performance and enabling stakeholders to make informed decisions. Continue practicing these concepts and applying them to real-world scenarios to strengthen your expertise. Thank you for watching. Best of luck with your ACCA studies and future accounting career.